Greetings. Welcome to this video series. My name is Kevin Matthews and I am the tax professor. Class is still in session because the learning never stops, and we want to say thank you very much for coming to this video in order to learn something new. So in this video today, what we're going to talk about is what's referred to as simple retirement plans. So there's two different types of simple retirement plans that there are out there. There is the simple IRA and then there's the simple 401k. And so we're going to talk about both of those and what they mean and how they can actually help you in your business to attract good talent, but at sometimes at a lower cost than you would have with traditional 401k plans. First of all, the thing is that the simple plan has several requirements. The first requirement is that you have to have 100 employees or less. And the reason why is that these simple plans are specifically guided towards the idea that you're a small business, and one of the things that really makes things very complicated for 401ks, they're just so expensive. You have to get audits with them. To fill out a 5500 costs a lot of money. And a lot of times, I have a 401k plan for my company, and it is incredibly expensive compared to had I just done like a simple plan for our employees. I actually opted to do the full-blown one because I wanted to be able to defer more of my income as a result of it, and we'll talk about what some of those limits are here in this video. And so you have two different types of plans, like we said earlier. You have simple 401k plans and you have simple IRA plans. The simple IRA plan is going to, and generally they work very similarly. The advantage of it is what's available to them, because oftentimes if you set up a simple 401k plan, it's still going to be run by somebody, and there could be potentially limited opportunities for certain investments to be put in. Generally I like the simple IRAs. I think they're phenomenal. I like to recommend them for clients all the time. And I know this isn't, I'm not trying to sell myself or anything like that. However, in addition to being a CPA, I'm also certified in human resources. And my area of expertise within human resources is compensation and benefits. I actually do some consulting on the side with some companies to help them with their compensation and benefits plans to help them retain and attract new employees. And one of the things that always comes to us is they say, gosh, Kev, I always get into this problem because everybody who wants to come work for me wants a 401k plan. And so what ends up happening is, if they don't see a 401k plan, they think we don't have a retirement plan. So sometimes what ends up happening, you want to do a 401k, but it's too expensive, or you don't have enough employees that you think would qualify, or maybe you work in an industry where there's extremely high turnover. For example, restaurants, a very good example. And if you do have a lot of turnover, maybe you don't want to do a 401k plan because they're kind of a pain if you have, this increasing number of people that don't no longer work for you. You still got to manage all their stuff because they still fit into your 401k plan. A simple plan actually will allow you to get around that. Now, one of the problems that we run into, and I kind of alluded this to an earlier comment, when in the compensation consulting area, if clients, potential employees don't see 401k, they think there's no retirement plan. Even though you tell them, hey, I've got a simple IRA plan, they're kind of like, simple IRA plan? What the heck is that? Most people haven't heard of these. And so what ends up happening is you kind of have to sell it to them. Now, if they say a simple 401k, they're like, oh, okay, well, it's a 401k. I'm happy. And especially when you have employees who may not necessarily be financially, financially sophisticated, shall we say. Sometimes that's good enough. Now, one of the limiteds that ends up happening, what they try to do with the simple plans is that in order to avoid a lot of the regulation requirements, they kind of box it, so to speak. So they try to make it as much one size fits all as possible. So what it does is that it says, look, if you follow these rules, we'll let you do these things, and that way we won't make you do all this other work that would necessarily make the plans cost prohibitive. So under a simple plan, any employee with compensation of at least $5,000 must be permitted to enter a qualified salary reduction arrangement. Now, under the arrangement, an employee can elect to have a percentage of compensation not in excess of $12,500 that's a 2018 number, by the way, set aside in an IRA instead of receiving it in cash. This maximum is indexed for inflation every year. So basically what happens is, if they make $5,000 or more, you have to let them in. And that's kind of the one size fits all. If you're kind of looking at it and saying, wait a minute, I want to put some limits on this. Maybe I don't want to have everybody have that in. If you're going to do that, then you're going to have to undergo the other 401k plan. That's a little bit more expensive. So the amounts that are taken out of an employee's salary and are contributed to the simple IRA are not taxable to the employee. Basically what ends up happening is what'll happen is that you'll basically report it on their payroll, their W-2. It's going to be a federal tax deduction, but it will not be a reduction for Social Security and Medicare taxes. The employee has to will make an election for a deferral, and then you have to contribute an equal amount into the 401k plan up to 3% of their compensation. So it's up to 3% of their compensation. If an employee with compensation of $50,000 elects to have 10% of their pay contributed to the plan, that's $5,000. You must contribute as the employer 3%, which would be $1,500. Okay, so if the employee decides, say for example, instead of 10%, they want to go down to 2%, then you just contribute up to the 2%. Okay. So, it's dependent upon how much they contribute, but it's going to be a matching contribution, not an unmatching contribution, okay? If the employer wishes to contribute less than 3%, say for example that you're having downtime, hard times. 2008 happens all over again. We're back in a mortgage crisis. I mean, God forbid that happens. I don't want to wish that on anybody. Basically, what ends up happening if you run into that problem, you can actually send a notice out to the employees that you're going to drop it from a maximum of 3% down to a maximum of 1%. But you can only do that for 2 years within a 5-year period. And so what ends up happening is, it's meant to sort of give the employer some relief during hard economic times. I mean, they don't want you to drive yourself into bankruptcy because you're trying to meet these contributions. That ends up happening. But at the same time, they don't want the employee to lose everything, as far as compensation to their retirement plans. Okay. Alternatively, if you decide to didn't want to do a matching contribution, you can simply contribute a flat 2% of compensation and move on. Okay, it's limited to $275,000 for people who are making for that money, and then for every eligible employee to participate in the plan, whether the employee elects to reduce the salary or not. Special notice must be given if they wish to take this approach. Okay, so if you want to do it this way, you want to say, I'm going to just do a flat 2%. I don't care. What's going to end up happening is you're going to say, okay, fine. We'll let you do this flat 2%, and as a result of that, you have to give that notice in order to the employee. That was all talking about the IRA. Now we're going to kind of talk about a simple 401k plan. By making matching contributions or the 2% contributions and satisfying the rules for those simple plans, simple 401k plans will satisfy the otherwise complex non-discrimination test for 401k plans. And I haven't done a video yet on 401k plans. I might do one later on. I mean, it would be a long video because there's just so much to talk about. Basically, if you have a simple 401k plan, it can't be discriminatory. In other words, you can't have it to where it excludes, it's only for the highly incompensated people. That they won't let you do that. Now, basically what ends up happening is you have to allow everyone to participate that meets certain requirements. And so the simple 401k plan gets rid of all of that. And so that sort of removes part of the need of an audit, which would take place because usually as part of the audit, we're going to do some of those non-discriminatory tests that we normally do. I actually do some audits in the employee plans area, and so this is something that we definitely look at to make sure that things don't get done. Now, luckily, I'm actually pretty lucky. The companies that we've hired they kind of do it for us, that actually ends up working out better because then I don't have to do the work on it. Contribution rules for simple plans applies for simple IRA plans apply to simple 401k plans, except that if the employer adopts the matching contribution approach, the maximum contribution percentage cannot be dropped below 3%. So if you're having bad economic times, tough. Deal with it. Okay, this is something that we've talked about in the past. Most of the employers that I speak with say they don't care. You know, unless your payroll is huge. I mean, you know, 2 to 3% usually is not going to be a big deal for most employers. Again, you know, it's an additional cost, so obviously, you know, it definitely matters. But it's just that it's not as much of a hit that most employers, when we talk to them about simple 401k versus simple IRA plans, they go, and if they go with a 401k plan, it's because they want to advertise the fact they have a 401k plan. Contributions to a simple 401k plan are not subject to the 15% limit on contributions to profit sharing or stock bonus plans. Okay. Simple plans have advantages of simplified reporting in the absence of qualifying rules from prohibiting the plan from discrimination against lower level employees, and those are advantages. You know, again, I love these plans when I'm talking to small businesses, because when we're talking to a small business that maybe only has 10-15 employees, these kind of plans allow them to offer that retirement plan to some of their employees, especially if they have younger employees, and then, you know, and you know, maybe the younger employee initially doesn't say that they need a 401k plan or an IRA retirement plan, but later on they're kind of saying, you know, it'd be kind of nice if we had a 401k because it would allow me to save for retirement. You know, and that's something that I tend to talk with clients about, and it's something that I would definitely recommend, you know, to take a look at if you're looking at 401k plans, but you just don't want to pull the trigger because you're just a little concerned about the cost of these. Okay, that's pretty much all I've got to say about that. This video probably will go a little longer than it should have. Again, thank you very much for watching this video. My name is Kevin Matthews. I am the tax professor. Class is not over because the learning never stops. Feel free to drop by here periodically. If you have any questions for me or any suggestions on content that you would like to see, please go to the comment box below and simply leave me a comment. If you want to talk to me one-on-one, you can go to my website at betasolutionscpa.com. Again, that's betasolutionscpa.com, and I'd be happy to have a one-on-one conversation with you about various topics. And you know, especially if you need any additional information about anything that we've talked about in these videos. I want to thank you very much again for watching this video, and have a good day.